Dollar cost averaging. What is it, why it's important, and how you can implement this investing strategy into your portfolio. Hi everyone, this is Camilla, the Focus Spender, and welcome to my channel. On my channel, I teach you how to get out of debt, save more money, and invest so that you can leave a lasting legacy. So one of the strategies that I've been using for the past several years that has really allowed me to grow a really nice investment portfolio is the strategy of dollar cost averaging. And what that means is that I am not trying to time the market. I am determining how much I want to invest for a particular year, dividing that amount by 12 or 24, depending on how frequently I want to invest, and investing on a regular interval. The whole point of dollar cost averaging is to minimize the risk of investing right before the market falls. So why is it important? I think dollar cost averaging is a really important investment strategy, particularly for beginners, because it allows you to just get started in investing as opposed to waiting for the perfect time to start investing. I think for a lot of new investors, they think that the perfect time to start investing is when there's a lot of buzz around it, when the market is going up and reaching all-time highs. And honestly, that's not when you want to invest. That's when you want to start pulling money out if you've been invested for a really long time and you really want to capture some of your gains. What tends to happen with new investors is that they jump in when the market is hot, and right away other investors are taking money out, so then the prices start to drop, and then the new investors, start to panic and think that they need to sell. But when you sell, you lose your money because now you're selling when the prices have gone down as opposed to when the prices have gone up. So when the market is hot is not when you should be investing. You should be investing when the market is a bit cooler and prices are pretty much on sale. More seasoned investors, day traders, and professional investors, they are spending hundreds and hundreds of hours researching different stocks and really trying to figure out the perfect time to invest into a stock. So they're looking at different data points, and they're looking at when the price is the most optimal, when the price has gone down, and that's when they are taking their large sums of money, investing it for however long, and then pulling that money out. You and I, we're not professionals, we are not day traders, and we should leave that strategy to those people over there. So how do you do dollar cost averaging? Well, good news, if you already have a 401k or 403b, you are already practicing dollar cost averaging because you're not taking 5% of your salary once a year and saying, okay, let me just dump this into my 401k or 401b. Your employer is already, doing 5% of your paycheck every time you get paid, and they're putting it into your investment account so that you are taking advantage of the price fluctuations in the market. So sometimes you're buying when the prices are high, but then other times you're buying when the prices are low. Now, if you want to do this on your own, you can do this in your Roth IRA. You can also do this in your regular taxable account. So with your Roth IRA or your traditional IRA, you know that you can invest $6,000 for the year 2021. And what you can do is you can say, I'm going to divide this amount by 24, and twice a month I'm going to put an equal amount into my Roth IRA. Or you can divide it by 12 and say once a month I'm going to invest into my Roth IRA. What I did this year was divide by 24, and I'm investing twice a month. In years past, I've done quarterly investments just because I just wanted to do large lump sums. But once a quarter, I would put in 25% of my investment. But this year, I decided to really spread things out a lot. You can also do this with a regular taxable account. Let's say you have Betterment and you're invested in ETFs, you can invest on a set schedule. Or if you decide you want to pick your own individual stocks, you can use an account like M1 Finance, create your portfolio, and set your investments on a regular schedule. That way, every time you get paid or every, once a week, you are investing in the stocks that you've decided you wanted to own. Now, if you're ready to start investing, but you're just not too sure where to go, be sure to download my free guide, the 14 questions you must ask yourself before choosing your next investment. And I will leave a link to that guide below. And I hope you enjoyed this video, and I will see you guys next time. Thanks. Bye-bye.